in the last 6 months, we've been able to renovate 5 of the 6 units, and the property is now cash flowing $2,400 a month.
Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larbi.
Hey guys, it's Sarah Larbi. Welcome back to Where Should I Invest? Real Estate Investing in Canada. Today we are speaking to Ryan DeLaurentis and Courtenay Hindemit. And Ryan and Courtenay are young real estate entrepreneurs. They are focused on commercial and multifamily real estate across Ontario, and their company is called DCI Properties, and they focus primarily on cash flow. And they purchase most of their properties with joint venture partners who are themselves looking to supplement their income and prepare for retirement and want a hands-off type of real estate investment. And Ryan and Courtenay are the active partners. On the flip side, DCI takes care of finding the deals. So Ryan and Courtenay find the properties, find the deals, they complete the due diligence, they actually also self-manage the renovations, they increase and improve the income, work on decreasing expenses, things like you want to do when you buy a multifamily investment, and they also oversee the day-to-day building operations. And Courtenay does all of the managing of the properties as well for DCI. And the cities that they're currently investing in right now, some of them are London, Niagara region, and Kingston. And the both of them, outside of real estate investing, have a dog named Otis. They enjoy going to movies, and a really cool fact about them is they don't actually own a TV. So if you guys are wondering how some of us are able to do this investing and have time for everything else, we kind of just pick and choose what we do with our time. And I'm personally a big believer in not wasting time sitting in front of a TV unless you're going to be listening to podcasts or something where you're learning. Some of us, and I encourage all of you guys to do that, is just find the time. You're sleeping for 8 hours, you're probably at work for 8 hours, you've got another 8 hours during the day, and the more that you can be productive and move things forward, the easier it's going to be. And then Courtenay and Ryan actually are launching a multi-family real estate networking educational club, and their first meeting is going to be on April 19th. So super excited. They're going to talk to you guys about that. So before we get started, I just want to thank everybody who has been able to come out to the annual So Right event this past March 22nd. We had a great turnout, about 200 people coming out to the event, and we had Dave Dubo speak on how to find money. So that was really awesome. The next So Right events, if you guys are interested in coming, for April is going to be on April 26th. So we are going to have a paralegal come out and speak about the new lease, as well as some of the clauses that you might want to add. And we're also looking to have a panel of lenders. So often we think about the other way of us trying to find money and joint venture partners. And we thought it would be really interesting to bring the reverse to you guys by having actual lenders or people like you and I, investors that might have some properties, but they're also lending their money currently out to these types of investors that are doing different types of deals, whether it's flipping properties or rent to own or different things like that. So we're going to learn about their points of view, what they look for in order to lend their money, what deals they like to lend their money on, and a few more things. And then we're also going to have our lightning round where we have a panel of 4 experts that answer some questions from you guys. So super excited. If you guys have not yet come and are interested in coming, please reach out to me. My email is sarah@sarahlarbi.com, or you can visit the website and go under the So Right tab at sarahlarbi.com. So without further ado, let's get on with our interview with Ryan and Courtenay. Today I am with Courtenay and Ryan. Welcome, guys.
Hey, what's going on, Sarah?
Thanks very much for being on the show. I'm really excited to talk to you.
Yeah, we're excited too.
So Courtenay and Ryan are multifamily investors, and today we're going to learn all about multifamily investing. So could you guys tell me and the listeners how you got started in the first place investing in real estate?
Yeah, for sure. So a couple of years ago, Courtney and I started reading a lot about other entrepreneurs and people like Richard Branson and Joel Salatin. And then we came across Robert Kiyosaki's book, Rich Dad, Poor Dad, which pretty well everyone seems like they've read who invest in real estate. And, you know, we just came across that big sort of aha, which is that we don't need to necessarily trade our time for money, and that we can trade money for money and start earning income from portfolio or passive income like real estate. So we actually read another series of his book, which I recommend people do. It's called What the Rich Teach Their Kids About Money That the Poor and Middle Class Do Not. So kind of finish off with that one. And then we literally jumped right in. We bought our first property, joined a couple of real estate groups.
We started, networking, talking to other investors, and trying to really figure out what the best strategy was that fit for us.
And then we kind of decided that commercial and multifamily apartment buildings would be the best vehicle to hitting our goals. And
we got a mentor, and
then we just started working with people that have been doing it for a long time so that they could help us out and kind of guide us through the process. So yeah, that's kind of how we got started.
So when was this? When did you actually get started?
I guess it would have been in late 2015, early 2016.
Okay, so fairly recently. And what does your portfolio consist of today?
So we have mainly small multifamily apartment buildings between 6 and 20 units. We've really sort of kind of hit our stride in the past 10 months or so. We've acquired 14 units and have raised roughly about $700K with our JV partners, which we're currently looking to put into some new projects in the cities we're investing in. So it should be growing fairly quickly over the next sort of 3 to 6 months.
Congratulations. That's really exciting for you guys. Can you walk us through your first purchase? How did you buy that first income property, and what is it exactly?
Funny enough, we are actually in the process of selling our first property.
Literally as we speak. I think when your listeners hear the podcast, it might already be sold.
So it's a side-by-side duplex in Cambridge. It needed a lot of work, and we took it on, managed the renovations, screened and selected tenants, and we are still currently managing the property.
So it was fairly turnkey, and we thought it'd be a great long-term buy and hold, because that we didn't really know at the time what our strategy was going to be. We just kind of knew that we wanted to get our money working for us in real estate. And then as we sort of took on the strategy of commercial and multifamily and saw the cash flow potential there, we just thought that this didn't work as much with our current portfolio. And it's a great property for someone that is looking for a long-term buy and hold. It's in a great location, and it is a side-by-side duplex. So, which potentially for people that want it as a mortgage helper by renting out one side, you don't have that person living in the basement. So I think there's a lot of good uses for it, but just doesn't necessarily fit with what we're looking for now. And we could potentially use that money into funding a bigger deal. So the first one was good, but probably selling it by the time this airs. So yeah, that was the first one.
Yeah, well, it sounds like you've got some better deals now that you're hanging on to. So it's definitely nice to see you guys upgrading.
Yeah, that's kind of the what people have told us, or seems to kind of be the running thought in investing, is that you take all your little greenhouses like in Monopoly and then eventually turn them into a big red one.
Why did you guys choose multifamily investing instead of single family homes or even flipping properties or different types of investing? Why multifamily?
There's a lot of positives that sort of drew us to this strategy. I think the number one was that it just offers better cash flow. There's more sources of income from rents, laundry, depending if it's commercial, you can get additional signage, parking, storage. So the cash flow for sure was number one.
Yeah. We find that they're more risk averse with vacancies. So again, additional cash flow covers your expenses and reserve funds, and shouldn't really leave you in the red, because they kind of compensate if something happens. You have somebody else in there helping fill that void.
And then, I don't know how much people know about this space, but it's also quite easier to finance. So I became self-employed last year in January, which if we were buying single family or duplexes would make it harder for us to qualify. But on commercial properties, the lenders are looking more on the financial stability of the building rather than on the financial stability of the borrower. So if the building can show that it covers its expenses and that it has a good debt service ratio, then lenders are much more likely to lend on it regardless of your sort of own financial situation. So that was fairly attractive, and it meant that we could grow our portfolio a lot quicker and make it easier for our JV partners to qualify. So that side on the financing is good. There's more room to negotiate with sellers. The purchase price and the appraisals that you do later on commercial multifamily are based solely off of the numbers. So I don't want to get too technical, but essentially the net operating income, which is just your income minus your expenses, and the cap rate for the area that you're investing in to basically determine what that purchase price or appraisal should be. So the better job that we do at increasing income or decreasing expenses essentially are what we're doing to force the value of that property. So we found that more attractive than, say, single family homes, duplexes, or flips, where it's a lot more based on market comparables, appreciation rates, and just things that are outside of our control. So we thought, if we're going to be investing a lot of money in real estate, we want to have as much control over that asset as possible. So those are kind of some of the main ones.
Wow, so a lot of great information there. So I have a few questions about that. In terms of multifamily investing, based on your knowledge and your information, how many units does that begin with?
It depends. It's actually a good question, and it does relate to part of the financing consideration as well. So most people will tell you 6 and up for multifamily. And then for commercial, you can have one retail owner, one office space, and have that be a commercial space. So, but on the multifamily side, it's 6 units and up. However, I will caveat that by saying that RBC are currently the only lender that will do a 6 unit at residential interest rates, amortization, and down payment, which can be pretty favorable because the income potentially out of a 6 unit can still be fairly good when you look at what you can get as far as your mortgage payment. So we found that there's a good sweet spot sometimes with the 6 unit properties with RBC and having them cash flow pretty well.
Okay, so definitely the financing piece being that you're self-employed. Is this your full-time job?
It's funny you ask. So outside of this, I am an insurance broker. And over the last couple of years, the real estate was more of a side business. And in the last 6 months to 8 months, this has really kind of taken on almost like a second full-time job where we're spending a lot more time on it. So yes, I do have sort of my insurance business outside of this, but the real estate is kind of becoming more of a focus as we're sort of growing the portfolio.
Okay, excellent. You mentioned in terms of financing, can you just give us an idea of when it comes to your multi-units, what kind of down payment is required and what are, as of, I guess, March, April 2018, what are some of the rates that somebody that's investing in multifamily might be looking at? And I know that you guys are not mortgage brokers by any means or anything like that, but just based on what you're getting and what you're being asked for, what do those numbers look like roughly?
So again, I think it depends on the property and whether or not it is commercial or multifamily. So I'll kind of split the question up. If we're looking at a multifamily property, you can typically expect somewhere between 70 and 80% LTV, meaning that you need between 20 and 30% down payment. The interest rates can vary, but we are usually looking between 4 and 6%, 6% being fairly high. I think on multifamily, it's fair to say, somewhere in 4 to 5%. And then the amortization is usually 25 to 30 years. Now, on multifamily, depending on the age of the building, you can go through CMHC to get the building insured. You do pay a premium for that, but the benefit is when you take that building to a lender and it has been CMHC insured, you can get a loan to value up to 85%, meaning that you only need 15% down payment. You can get interest rates as low as 3.25% to 3.5%. And the biggest thing is that they can stretch the amortization out to potentially 35 or 40 years, which drastically improves the cash flow of the property. So that's kind of on the multifamily side. And then on the commercial side, it really varies. The down payment can be anywhere between 25 and 35 sometimes percent. And the interest rates and AM vary just depending on the type of commercial property it is.
Okay, amazing. Thanks for sharing that. And a lot of the listeners know this, but I'm a big cash flow investor and I always talk about cash flow. Can you give us an example of one of your properties that cash flows really well and what the rough numbers look like?
The last one we did was a 6-unit in London. We bought it for $575. When we bought it, it currently cash flowed about $1,200 a month. That's after expenses, mortgage payment, vacancy, and maintenance fund. So it was doing okay. I mean, it's doing fairly well. And then in the last 6 months, we've been able to renovate 5 of the 6 units. And the property is now cash flowing $2,400 a month. And we're currently just going through a refinance with RBC and should be pulling out hopefully around $100K out of the property.
Wow, amazing. Congrats.
Yeah. So it's exciting. We actually just had the appraisal done yesterday. Courtney actually drove out to London to meet the appraiser and kind of go through with him. But yeah, so that's we're just waiting to hear back. But it's exciting. That one's gone fairly well so far.
Great. So as a listener, why would somebody want to consider multifamily investing? And what are some of the things to consider, right? So what are the pros and what are the cons of multifamily investing?
Something to consider is just really doing your due diligence, getting your receipts, getting your statements. If they've told you they've done capital upgrades, like they've done a roof, get that receipt, call the contractor, call whoever has done the work and verify that what they're saying is true.
Yeah. It
happens all the time. They'll tell you they've done a roof and in fact they've done a patch job, and that's a considerable difference in cost. So to know what you're getting into is really important.
Yeah, definitely making sure you're going through your due diligence, getting fire inspections, making sure that it's zoned correctly for the use that the seller says that it is being used for.
Even utility bills,
yes,
verifying that sometimes they just round numbers or make them up, which is fine. Just ask for those copies of the bills and check that what they're saying is true.
As far as what someone should consider when buying, a commercial or multifamily property, it's really important not to rush the due diligence step, because you're going to have your realtors, your mortgage brokers, your lawyers. You might, and I mean, more so the realtor is going to want to push you to get the deal closed, because they want to get it done and they want to get paid. But just remember that as an investor, it's your job to protect your or your partner's investment. And that, while your team may be in on the deal for the next couple of months, you may be in on the deal for the next 5 to 10 years. So really make sure that you're doing your due diligence when looking at the property and just hitting all those points to make sure you've, like Courtney said, gotten receipts and checked on some of the work that they've said that they've done.
So let's take a step back for a moment. And I'm just curious, how long, when you have a deal under contract, how long do you ask before closing?
It depends on the property, but usually 45 to 60 days.
Okay. And then during that period or that due diligence, in your agreements, what do you make it conditional upon?
Yeah, there's a fairly good list of conditions that we have.
Financing, we always get inspection, just the primary ones, and then depending on what the building looks like, we change what other ones to add on top of that.
You're
Junk
getting-
removal is a great one to have in there because you're dealing with a building and owners just gather junk in there because they can, and then they leave it, and then you have a big upfront cost to have somebody, you know, who's left a water heater behind that you have to dispose of. So they can leave big items, and having junk removal in there is a good one.
Making sure that on the inspection you can bring other members of your team, so whether it's a roofer, an electrician, a contractor, and just really knowing what you're kind of getting into on the building and making sure you kind of know what those costs are beforehand. So yeah, those are all things that we make sure to include in the conditions. So, and the conditions on a building are sometimes a little more lengthy than they would be on, you know, say a single family home or a duplex, but there's usually good reason for it. There's a lot of due diligence that needs to be checked, and getting copies of, even getting something as simple as lease agreements or tenant acknowledgement letters to prove that the tenants that are in those units are actually paying the rent
that they say that they're paying.
Yeah.
Some really good advice. You mentioned also being able to renovate a few of your properties. Is that because the tenants were leaving, or why is that?
It's a bit of both. So we've had some properties where we're able to get a unit vacant on possession, which is great. You're able to go in there, renovate that unit, and then typically we'll try and see what the other tenants are like and offer it to, you know, someone we think is a good tenant in the building, offer them the new unit, hopefully for more than what they're paying. It may not be right on point with market rents, but if you can at least bring their rent up a little bit, that helps. So sometimes we can just kind of move people in and around, you know, so one person moves into your new renovate, and then you can do the same thing and just renovate the next one and see who fits to move into that.
And then, you know, if there are potentially tenants that maybe they're paying below market rent, or they're not happy with the building, or we foresee issues down the road, we potentially will look to offer them a move out bonus, where we'll take care of either their first and last month's rent, moving expenses, to sort of help them in finding maybe a more suitable place to live, and again sort of allows us to renovate the unit and get someone that's maybe paying closer to market rent.
Cash for keys. That's a good idea.
Cash for keys. Yeah, get those N11s.
And then what about like phase one environmentals? And there's different assessments and different things that you'd need to do with a multifamily. Are you doing those?
Yes, not necessarily on multi-family properties, but on commercial, yes. And so that's also something to consider as maybe a risk or downside to this space, is that you could potentially end up spending anywhere from $2,000 to $7,000 in appraisals and environmental phase 1 and 2s, just doing your due diligence, and you may end up walking away from the property. So that you do run that risk, but it's a risk versus reward. You know, these properties can cash flow fairly substantially if you get them up and running, and you know, it's just kind of part of the deal. But yes, depending on the property, those are things that would need to get done.
Okay, great. And the deals that you're finding right now and that you're purchasing, how do you come across them? Are they off MLS? Are they on MLS? How are you doing that?
Again, it's a bit of both. We have had success with finding off-market listings.
Yeah, we have a lot of people working with us and for us in the cities that we're investing in. So we try and connect with, when we target a city or a market and say this is one that we really want to hone in on, we try and connect with as many people in that city as we can to let them know exactly what we're looking for, so that when they hear something that comes up, they think of us first. They think of Ryan and Courtney with DCI, and they'll get in contact with us and bring us that first. So whether that's realtors, property managers are actually a pretty good source of deals, because they're the ones that are actually managing the property for the owners. And for them, they would rather not lose that business to somebody else. So they're actually a fairly good source of bringing deals. Mortgage brokers, other investors, wholesalers. There's a lot of people we try and work with, but it's actually, we're in a good spot now. We're getting a lot of, you know, our last deal came to us through a realtor off market. We're working on one right now, which is a mixed use commercial multifamily property in downtown London, and that came to us sort of exclusively. So we do come across them on the MLS on occasion. And when we do, we'll still follow our same due diligence process and see what kind of discount or how much money we can save our investors off the purchase. But a lot of them are coming off market now, which is great.
Amazing. So you mentioned JVs and joint venture partners a few times. Can you walk me through how you guys are setting that up?
As far as how we're meeting them or how those get structured?
I would say both. I mean, I think you guys are very, very good at networking. I've seen you at many networking events. So let's start there, and then let's talk about how you structure them.
Yeah, sure. I mean, we do try and put ourselves out there and go to as many networking events as we can. So we have met partners there that know what we do now and know the space we're in, and we can show them the track record of properties that we've worked on. And that's worked really well for connecting with people and just being able to sit down and show them what we do. We've also had some success with our own sort of internal circle of just family and friends. And I know some people are kind of nervous about reaching out to their family because you never want to come off as the person that is, asking for money, but we haven't had to, which is a good thing. I think if they know you, I think it's important when you're working with other people and their money that they know you, like you, and they trust you. So if it's a family or a friend, they hopefully should know you.
Hopefully they like you.
Hopefully they like you. And then it's just about getting them to better understand what it is that you're doing so that they can trust you. And it may take a little bit longer on that front for them to kind of get a better grasp of sort of what you're doing and the strategy you're using. But yeah, all those are kind of ways that we've sort of connected with people, and so far it's worked pretty well.
So when you were first starting for your first one, did you have a joint venture partner or was it the two of you?
Well, the first duplex that we just bought ourselves. And then the actual first multifamily property we bought with a JV partner.
Okay. That's great. And so can you walk me through how you structure the partnership and how you structure the deal with the JVs?
Yeah, I mean, it does vary on every deal and from partner to partner, depending on, how much money they're putting up or the size of the deal or what they're looking to get back on it. But in essence, it's usually sort of a 50-50 split where we're sharing the cash flow and the future sort of equity of the property. But we always make it our first priority that the investor is getting their money back, whether it's on a refinance or on a future sale of the property. We're making sure that they are getting their initial investment back. I think there's a good phrase or quote that I've heard. It's not as the return on investment is not as important as the return of investment. And I think that's really important and something that we strive for. So most of the properties we're looking at, we're trying to find something that we can turn around in the first sort of 6 to 24 months, which will allow us to refinance the property and pay back most of our partners' initial capital.
So your exit strategy is within that time frame, 6 to 24 months to have them paid out. And then what do you do with the property afterwards?
Well, they may not be paid out in the first 6 to 24 months, but we at least want to try and get back some of that capital. And then we sort of give a 5-year window. And after that 5 years, we can assess our options, which typically are we can either continue to hold the property if it's cash flowing well and we want to continue down that route. If we both agree to sell the property, we can go that route. Or if one partner wants to move on and the other one wants to continue to hold it, we can potentially have the option of buying out the other partner's share of the property. Typically, we're only ever working with one partner on the deal, so it makes it fairly easy and smooth for that exit strategy.
Okay, great. So what are like some of the first few things that you'll do upon getting possession of a multifamily property? Do you have any specific things or processes and procedures in place from day one of owning the property? What does that look like?
It really depends on what the property is, but essentially we would assess the units that have the highest cash flow spread, so the ones that are paying the most under market rents, and what we can do to bring those up.
we're always just looking for ways to either increase income or decrease expenses. So, I mean, before we actually close on the property, we usually have a fairly good idea of what our plan is going to be for that property. And we've already laid out that plan to our JV partner in detail, so they know exactly what the costs are going to be. And we have a fairly good idea of timeline. So I know your question was in regards to what we do after we close, but a lot of what we actually do happens in that, sort of 45 to 60-day window before we acquire it, where we're actually, sourcing how much the renovations are going to cost, which ones we're going to do first, whether or not we need any capital upgrades like windows or roofs or anything like that. So it's funny, actually, after we close, it's a little bit easier because we already have the plan in place.
Okay, perfect. That's awesome. And so in terms of management, who does the managing? Is that you guys, or do you hire it out? How does that work?
Primarily, I do most of the property management.
Okay.
At least for now. On the smaller buildings, Courtney's sort of taken that on. But as we sort of get into bigger properties, I think we're looking to hire that out and hire our own property manager who would take that on.
So Courtney, I'm sure there's a lot of people that ask you, as somebody that's a new investor looking at multifamily, it might be overwhelming just managing so many tenants. What are some of the things that people should be aware of?
It's an interesting process because most of the time you're inheriting somebody else's tenant. So they may not be your ideal tenant. I had a tenant once who didn't even own a phone. So that was an interesting venture. So for trying to figure out how to communicate with him, and I had to get, people to just go knock on his door because I needed to talk to him. So that you just really never know what you're going to get.
You try and work with the good ones and at least let them know that they're appreciated and that they're helping you out, I think. But
yeah, we introduce ourselves. We send out a letter just saying, there's new property management taking over. We'll do our best to make this a smooth transition. If you have any questions, this is how you can get a hold of me. Try to set up how rents are getting paid moving forward, and just keeping an open line of communications. We try to see also if there's been anything that has been neglected by the previous landlord and try to fix that, to the best that we can in the first couple of days so that, they're like, oh, I'm not going to get dismissed again. And they're going to try and help me out. And they don't mind that I'm here, that kind of stuff. Because I think sometimes when you're taking over a building, the tenants are nervous and they don't know what you're like and you don't know what they're like. And you just want to make it a smooth transition and make sure everybody's happy.
Perfect. Awesome. Yeah. Thanks for sharing. So a husband and wife team. You guys are a dynamic team, and I always see you guys together and at a lot of real estate events. What kind of tips can you share and help others, be a successful team and invest together? Like, what kind of tips and feedback can you provide us?
You spend a lot of time together. So it's very easy to get irritated and I think communication is really key. And I think another important part is to try as best you can to separate your personal from your business. So I feel like Ryan and I have a great, strong relationship and I think we're pretty good at keeping business. And I think we're different business people than we are relationship. I don't know why or if that makes sense.
And just taking time to really to separate the two, I think is important as far as the actual relationship. And then in the actual business itself, I think it's good to have a division of roles because, what I'm good at or enjoy doing isn't necessarily what Courtney enjoys doing. And I think we've learned that and we're continuing to learn that as we work together. I think that's important if couples are working because as much as you may want them to be good at something you're good at, they may just not be. And they might not really want to do that. So, Courtney takes care of managing most of the renovations on our properties, and she takes care of the property management. For me, those aren't things that I necessarily want or like to do. So I focus more on the financials, sourcing the deals, and some of the legal and JV stuff. Because I enjoy doing that, and that's something that I really like to do. So, if I can offer any sort of tips or ways to help other couples, it would just be trying to figure out what you're good at and what you enjoy doing within that actual business itself, and then divide up the roles for, what each of you like to do.
And also try to spend some time not talking about business.
Yes.
Which I think is also good.
Very
sometimes,
important.
we just are like, we need to get out of here, we'll go have dinner, but we are not allowed to talk about business. It has to be.
Yeah, non-real estate related.
Yeah.
That's good. It's nice to set some division and some boundaries. So just out of curiosity, was it both of you at the same time that all of a sudden were really excited about real estate, or was it Courtenay or was it Ryan first, and how did that all happen?
I started reading a couple books, I guess. I think
I'd say it was Ryan.
Yeah.
It was Ryan kind of started. I mean, I was hesitant on the real estate and investing and being a landlord and what that meant. But I do really see the benefits in it. And he's, just opened my world up to that. And I'd say Ryan really got that ball rolling.
Awesome. So what's the next big move for you guys?
Well,
it depends. It depends which one you're talking about. So I'm not sure when this airs, but currently we have a refinance on one of our properties. We're working on the sale, as we mentioned, of that duplex in Cambridge. We have an accepted offer on a new multifamily property in London coming up on the 20th of April. And then we have a pending offer on a commercial multifamily property in downtown London as well.
Wow, you guys have lots of stuff on.
So depending on what you're talking about, it depends what that is. But no, for the next big move, we came in contact, actually Courtenay did, at an event with a investor that has a 24 unit building that we're looking into, which would be closing in sort of July or August. That looks fairly attractive. And then we're working on a bit of rebranding for our website and just adding some more video content for people that want to know what we're up to and how our strategy works. And so we're going to be working on that. And then, which is fairly exciting, we have our own club with a couple other investors that we started that is kicking off in April.
Can you tell me more about that club? It sounds really exciting.
Yeah, sure. So we're going to focus primarily on commercial and multifamily real estate. And I think our goals are fairly similar to the club that you guys have with So REIT, which is just around education and networking. And myself, along with the other investors that have started the club, we go to a lot of events and we feel that the speakers that they have out or the content that's provided is more so driven to flips and single family homes and long-term buy and holds, converting houses to duplexes, pre-construction condos. And those are all great, but I don't think enough attention is given to the commercial multifamily space, which I think a lot of people want to get into, but sometimes are daunted by how different it is. So we're trying just essentially to bridge that gap. And we want to try and bring in experienced people who are in that space, who can give short presentations to our audience, who can take that away and start applying it right away. So at our next meeting, for example, we have a mortgage broker coming out who is going to explain how an underwriter would look at a commercial multifamily property so that they know how to calculate NOI, they know how to calculate debt service ratio, and they can take that 20-25 minute presentation and start applying stuff right away to their own business. So that's kind of the idea, but we really just want to have fun, get people together to network and do more deals. That's coming up on April 19th. It's going to be at 7:30 p.m. at the Hilton Garden Inn in Oakville. So it's right off the QEW. We are charging $25 for attendees, but we wanted to provide your listeners with a bit of a discount. So if they reach out to us or to you that they'd like to come out to the event, we can give them $15 off. So they only need to pay $10 to come. It is cash only at the door.
And that offer is only for the first event.
For the April 19th event. We have a couple other ones booked already, and we've had a lot of interest from people wanting to come out. So I think it'll be a pretty good mix of seasoned investors and people that are just starting out that are looking to get into the space. So it should be hopefully a lot of fun.
I'm planning on going, so I'm really excited to learn more about multifamily investing. And guys, For those of you that are interested in attending, if you wanted to email me, just make sure that you reference Ryan and Courtenay, or if you're going to email Ryan or Courtenay, reference the podcast so that we know where to apply the discounts. So just mention where should I invest, or you can email me. But Ryan, if they want to email you or Courtenay, how can they reach out to you?
Yeah, so the best email is ryan@dciproperties.ca. And that's just D as in David, C as in Charlie, I as in India, properties.ca.
Amazing. And registration starts at what time?
7 o'clock.
Awesome. Okay, cool. Thanks for offering that to the listeners. So are you guys ready for the lightning round questions?
Yes, I think so.
So you guys both get an answer to the lightning round question. So Courtenay, you can go first,
wow, okay.
or vice versa. If you guys have the same answer,
Okay.
that's fine too. You ready?
Okay.
All right. Question number 1. What is your favorite real estate investing book ever?
I have read Pitch Anything by Oren Klaff, and I think it's just a really great book on how to present yourself, present ideas, talk to people. It's a really good starting off if you're looking at JVing, raising money. It's great.
Great. Ryan?
And mine would be, it's called The Brand New You by Julie Broad, who I think a lot of people will probably know, but I think I've listened to that book twice now. It's really, really good for how to brand yourself and just let people know what you're doing and how to tell your story. So that's a really good one.
Great. Question number 2. What is your favorite podcast? Courtenay?
Yours, of course.
Okay, Ryan?
Yeah, I would say, so aside from this, we also listened to one with Rob Brake and Sandy McKay called Breakthrough Real Estate Investing. So we've heard a couple of those, and those have been good.
Question number 3. What do you do for fun aside from real estate?
So we have a bulldog named Otis, and we love just playing tug with him. Or
he's quite the character.
Yeah. So for people we have a rare breed of bulldog. So he's called an Alapaha blue blood bulldog, but he looks pretty similar to an American, but he is awesome. So we like taking him to the park and playing tug or.
Awesome.
We do other things like movies, but not much really. I guess we primarily work and watch movies, but yeah.
And play with a dog. Okay, so number 4, if you lost all your money and assets tomorrow, how would you start again?
I think I would continue to invest in knowledge, because I think that that's something that can't be taken away or lost. So if I had to start again, I think I would just continue to invest in my own brain and use that to, whether it's fund future deals or partner with people, but I think just continuing to invest in yourself.
Great. Courtenay?
I would probably second that. I mean, if you have nothing, knowledge is free. You just have to be willing to go and get it. Or it can be free. Sometimes you got to pay for nothing. But primarily it's a good starting point. And, most people are really open and willing to talk to you. Another good point, when we started looking into investing, we were listening to actually Rob Brake's podcast, which was excellent. And the first things we started to do was reach out to those people on those podcasts. Hey, how'd you do that? What are you doing? What happened here? Or, and everybody was always really open and responsive, and
willing to share. Yeah.
Very cool. That's a great thing. And you know what? I get a lot of emails as well from podcast listeners, and it's a community of people, I think, that like to help one another. So thanks guys for reaching out, and feel free to keep reaching out, and definitely reach out to Ryan and Courtenay as well. It's really cool, because before I became an investor, I thought it was a competitive thing and everyone's scared to share what they're doing because they don't want people copying them. But it's like the total opposite. I feel like people that are successful want to help each other and learn from one another. And it is not what people think it's going to be. It's so awesome.
It is. Yeah. It's really neat to see how much people are willing to share and sort of help pull you along in the process. So yeah, I would have to second that as well.
So question number 5, if somebody has $50,000 and they want to get started, how would you recommend that they spend it?
I would say, and I know it kind of goes back to question number 4, but I would suggest putting part of that into investing in yourself and investing in knowledge. There's actually, I know you can't see it, there's actually a quote that I have above my desk, and it's from Benjamin Franklin. And it says, if a man empties his purse into his head, no one can take it away from him. An investment in knowledge always pays the best interest. And I think what we've found in our journey so far is that, doing a course or having a mentor or, paying for that extra learning, whether it's a book or whatever that form of knowledge is, really helps develop you and your brand and your knowledge around the subject that you're investing in. And I just think that that's such a powerful ROI because it's almost indefinite as far as how far that takes you in the future.
Very well said. Courtney, anything you want to add?
No, I think that, just mentors, I think sometimes people get caught up on the price of what that can be. But if you find a great mentor, they add so much value and just that support that you need sometimes, I think, when you're starting out. And this real estate investing can be scary if you don't know what you're doing. You can get yourself into probably some pretty big pickles, but I think just the support of a mentor and the knowledge that they're bringing is beyond beneficial.
If a listener wants to find you or know more about you, how can they reach out to you?
Yeah, so they can reach me and Courtney at ryan@dciproperties.ca. You can also visit our website, which is www.dciproperties.ca, or you can contact my cell, which is 416-556-9221. And I think we were just talking about other people that have helped us along the process. And if someone has a question or they're looking to get into commercial and multifamily investing, we'd be happy to help them out and offer them some advice.
Thank you. And then on that note, any final words of advice or final tips for the listeners?
I think we had mentioned earlier, but when you are getting in this space, just be cautious because it is a space that does have some sharks and some shady. I mean, I guess real estate in general will have that in any size of property, but to really make sure you're doing your due diligence. And if I can just share a story on one of our past properties, we actually had a seller who told us he had done half of a roof reno. So when we went through to do our due diligence and called the roofing company and the actual roofer who did the work, he said he had done a patch job for roughly about $1,700. And the receipt that the seller had provided us actually showed $17,000. So I think he likely just added an extra zero to the receipt to show that he had maybe done more than he actually did. And we only found that out by doing our due diligence. So we went back and told them we were only going to close on the property if they agreed to credit us on the purchase for the roof, which they did. But had we not done that and reached out to the roofer, we may have been stuck with, a $20,000 roof renovation that we weren't expecting. So I think it's a competitive space, but I really think the due diligence process is where you can save and make a lot of money.
Wow. Yeah. Great on you guys for doing that due diligence. So I want to thank you, Ryan and Courtney, for being on the show today and sharing your knowledge on multifamily investing with the listeners. I think you guys provided some really, really informative tips. And if anybody wants to reach out to Ryan or come to the Real Estate Club, please send him an email or send me an email, and see you guys in a couple weeks. Thank you.
Awesome. Thanks, Sarah.
Thanks, Sarah. Talk to you soon.
Take care.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larbi. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest.